Well, good afternoon, everyone, and thank you so much for being here. And we are celebrating today the 10th anniversary of running these events, and it doesn't seem possible. And with that, we like to think that every year we continue to innovate. So even though it's our 10th anniversary, it is our first afternoon event. And we'll be looking for feedback as to whether this should be a regular venue, especially in the wintertime. It is our first live audience via internet that we are streaming for the first time to broaden this out to make clients available who are not either in the area or not able to make it. And it is the first presentation of this decade. So welcome to 2020. And I do want to thank my staff, and although they're not all here represented physically today, any of you who have worked with 1015 Associates, you know that everything we do is a team effort. And everybody has a part in putting together these presentations to get everybody here. So I want to thank my staff, thank them for doing this now 20 times, and we continue to get better and better at it. As I started putting together the information for this afternoon's presentation, I started thinking about July of 2018. Back in July 18, we were on the verge of entering into what would become the longest bull market in history. And I remember closing out the event that night saying, well, why can't it be? And here we are, 18 months later, and this bull market continues to rage higher. And so who would have known? And so as we begin today, the format of the evening, for those of you who are not familiar with it, is we're going to talk about where we've been, where we are, and where we may be going. We'd like to start out with some trivia, just to get your minds going, ask you a couple of questions, just to get your brain started. So we're going to start out with, the US cold, wet weather may cause a shortage of umbrellas, French fries, or dry socks. French fries. The type of potatoes that are harvested to make French fries and potato chips are harvested very late in the season and are subject to the potential of being killed by frost. The next one is a new innovation that could save thousands of frogs. Synthetic frog cadavers, lakeside frog pergolas, or antifungal frog cream. And by the way, that's a mouthful. Or all of the above. Synthetic frog cadavers. Think about the science classes around the country dissecting frogs, thousands of them every year. So if we could develop one that's a complete replica. And last but not least, which of these products is produced using recycled coffee grounds? And by the way, coffee is the second largest commodity in the world. We consume 2 billion cups of coffee a day. That's a lot of coffee grounds. So are we repurposing for high quality milk, fireplace logs and pellets, or for odor resistant sneakers, or in this one, all of the above? All of the above and then some. So let's get on into the presentation. Where have we been? This is a quote from CNBC, which was actually in early December, and this really sums it up. 2019 was a remarkable year. From stocks to government debt to corporate bonds to commodities, no matter where you went, you reaped profits this year. The S&P 500 is up 25% and counting. Treasuries, which tend to fall when risk assets rally, also gained in 2019. Oil, gold, and corporate bonds all scored double-digit returns. When the final numbers came in, S&P 500 up over 31%, MSCI World Index, ex the US, up over 21%. Emerging markets up 18. Corporate bonds up 9. Commodities were up, gold were up, and REITs were up. Asset classes across the spectrum rallied. This was not exclusive to just the United States. Markets across the world, Russia up 41%. Greece, being referred to as the comeback kid, up 39%. Egypt, 38, Ireland, 35, and New Zealand, 34. Markets around the world rallied. There were some soft spots, but in general, things across the board went up. Unfortunately, when it comes to money decisions, people are not always rational. And the commentator here says, today's stocks dropped on the theory that the higher stocks rise, the greater the chances are that they will fall. There's a lot of people probably sitting in this room today thinking about selling stocks simply because they went up a lot last year. Is that a rational decision? We won't know till hindsight, but we're reminded of the psychology of the markets. There's actually a book, The Laws of Wealth, Psychology and the Secret to Investing Success. And I love this quote. The fact that people are fallible is your biggest enduring advantage in the accumulation of wealth. The fact that you are just as fallible is the biggest impediment to that very same goal. We tend to be our own worst enemy when it comes to the emotion of investing and managing money. We're going to talk about the types of things that trip us up. And this happens to be a year where the markets and the media are going to be wrought with a lot of headlines. And so these are the things that tend to really trip people up. What we call confirmation bias. Confirmation bias is simply going out there and looking for the information that you want in order to prove your own hypothesis. Rather than assessing all the information that is out there to come to a decision, we look for information that's going to justify what we think. Information bias. This is basically using irrelevant information in order to make a decision. For example, the market's going up and down an awful lot. I'm going to sell my stock because the price is going up too much, going up and down too much. Does the daily price movement have anything to do with the reason you bought that stock for the long-term wealth accumulation? No, it doesn't. But it drives decisions. Loss aversion. The most common mistake that investors make. Think about December of 2018. One of the worst Decembers in history. As the market is falling, people decide to do what? Get out to avoid more losses. And what did they miss? The huge turnaround that we got in 2019. So the aversion to loss can lead to a lot of mistakes. Oversimplification tendency. This is an election year. You're going to hear lots of rules about how to invest your money based on the election. Oversimplification are things like, well, the market's going to go up or down based on whether the AFC or the NFC wins the Super Bowl. The market's going to go up or down based on the direction of women's hemlines. There's all types of them out there. And hindsight bias. How often have you said to yourself, I should have known that. I should have seen that coming. I was going to call you and have you sell out my whole portfolio. I should have known to do that. It causes frustration. And frustration typically leads to bad decisions. So these are the things that influence us. And when we're a year like we just came through, all of these things are going to be coming at us. And what I want to remind you here this afternoon is that you're all here because you invest to reach financial and life goals. And you all have different goals. And different parts of your portfolio are meant to help reach those goals. If you have something near term, you should have money dedicated to that. I remind people at times like this, you typically don't need all of your money all at one time. So let things go and do what they're supposed to do. When fear of loss drives investment decisions, one of the most interesting things about 2019 is this. The S&P 500 is having the best run in 6 years, but individual investors are fleeing stocks at the fastest pace in decades. Analysts say the trend highlights investors' apprehension toward a stock market buffeted by long-running U.S.-China trade war and lingering worries about a potential recession. Information bias. You hear the information, it justifies that you're afraid, so you go ahead and get out of the markets. Not the best thing to do. Making changes, getting in and out of the market. We have talked about this before, and these statistics are staggering. This shows the accumulation, the first bar chart, the accumulation of a $10,000 investment over the last 31 years in the S&P 500. If you missed just 5 of the best days in 31 years, you would have missed a third of the returns of that entire period of time. If you missed just 10 of those days, you would have missed out on half of the returns. This does not account for those who get out at the wrong time and then get back in at the wrong time, because what do? We tend to repeat the same mistakes over and over again. So what we want to avoid is jumping in and out of the markets for reasons that don't make a lot of sense. It does not mean that it is as simple as buy and hold. That there's a lot that goes on in managing your money besides just sitting and staying with the same things. There's a lot of reasons to make changes. Number 1, your goals have changed. There's a reason that we want to meet with you guys a couple of times a year. Things change, and if your goals have changed, we possibly should be making change to your portfolio to reflect that. Sometimes these are great things. We spent a lot of time at the end of this year sitting down with people who wanted to make gifts at the end of the year, make charitable contributions. Maybe it's a great time to plan that trip that you never thought that you'd have the capability of doing. Assess those goals and see if your portfolio should be changed accordingly. Your risk tolerance has changed, and it could get greater or lesser. Maybe something has changed, and again, look at what has happened in the last decade in these markets. I have the fortune of sitting with families today and saying to them, you no longer have to worry about running out of money. We're managing for second and third generation. That may change your risk tolerance. You've had a major life event. Maybe it's an illness. Maybe it's an inheritance, something good. That can change your investing goals. It's time to rebalance your asset allocation. Know this. We are doing this in the background for you all of the time. One of the things that I think investors make that is a big mistake, especially on the heels of a year like we saw this year. If you started out 2019 with a balanced portfolio, 60% of your portfolio in stocks and 40% of your portfolio in bonds, I gave you the math. If the stocks went up 30% and the bonds went up 10%, guess what? You've got a greater percentage of stocks at the end of the year than you started the year. We call it risk drift. People forget to go back in and rebalance things, and when the next correction comes, guess what? You're too exposed. You've got too much risk in your portfolio. We are constantly going in and rebalancing to make sure that your risk does not drift where you intended it to be. Better relative opportunity. One of our biggest jobs every day, and with Brian on staff now, going through every company that we've chosen to have in your portfolio, is there a better opportunity? Has that company given us the most of what we thought it would provide for us? Should we be moving on? Those are appropriate investment decisions, and they're being done in the background for you every single day. Fundamentals have changed. The fundamentals of a company can change. The fundamentals of an industry can change. The fundamentals of our economy can change. Those are reasons that we should be making changes to your portfolio. Those things we're assessing for you every day. Earnings, number one. The earnings of a company can tell us a story. It can tell us what's happening within that company and within that industry. We want to assess those earnings of what we call the price earnings multiple. Are the earnings relative to price at a level that we're comfortable with? Is that stock too expensive right now? Is there something that offers more value? Those earnings are the underlying piece that tells us that story. Does the company pay us a dividend? Dividends are absolutely critical. If you're investing for income and you've got a dividend and that dividend is solid and we're comfortable that it's going to stay and that it's going to grow, that company can remain in your portfolio for a long time. Even if you're a growth investor, the dividend can tell you about the sustainability of the growth of that company if we understand what's happening with the dividend. So fundamentals matter. Fundamentals become the basis of making decisions of when we're in the out of the market and what we own within the market. Coming into 2019, one of the biggest concerns were earnings. 2018, slam dunk. Earnings growth was over 20%. We talked about that. We had a corporate tax cut at the beginning of 2018. Corporate tax rates went from 35 to 21, dropped to the bottom line, so we got this big earnings push in 2018. What is Wall Street? What have you done for me lately? So we're always looking back to the previous year. So when we came into 2019, we knew we had this look back to compare to 20% earnings growth. And the fear was that earnings were going to collapse. Well, we didn't have growth above that 20% plus, and that's kind of realistic, right? But earnings did not fall off a cliff. We had good, solid earnings growth throughout 2019 to justify that when stocks turned around, they didn't look back. Trade, we've been talking about trade for the last 2 years now, and we just signed phase 1 of that trade deal this week. By the third quarter, it was evident that trade was becoming an issue within corporate America. We're going to talk about this in a couple of ways. FactSet broke down third quarter earnings into 2 different buckets of companies. They looked at companies who had 50% or more of their earnings within the United States. Those companies had real earnings growth. Then they looked at the banks around the world. What this map shows us is that we have had a coordinated effort of central bankers and our Federal Reserve to do what is ever necessary to continue growth around the world. All of the areas on the map, anything that's in blue or shades of gray and white, these are countries that are stimulating in some form to help growth. The areas of red on the map are parts of the world where which they're raising interest rates or trying to throttle back growth a little bit. So central bankers have been working effectively to maintain growth, and it's working. North America is expected to continue to grow by a little over 1.5% next year. And as you can see, the growth numbers for other parts of the country, real growth will be from areas of developing and emerging economies around the world. We do have a lot of problems to deal with. Talked about a lot of good news so far tonight, this afternoon. And when we talk about some of the issues out there, debt has to be front and center. As a country right now, we are running a $1 trillion annual deficit. We are spending $1 trillion a year more than we take in. We're at $23 trillion and counting. And the disturbing line on this graph should be that line over the top, which is debt as a percentage of GDP, which means that our debt is more than 100% of GDP. And it doesn't look to correct itself for any time soon. Debt is probably not a major issue today, but it's percolating in the background, and it's something that will eventually come back to haunt us, at least as most of us are concerned. The Peterson Foundation, which is a group that concentrates on educating people on government spending and government debt. And they put this very well. A strong fiscal outlook is an essential foundation for a growing, thriving economy. With a strong fiscal foundation, the nation will have increased access to capital, more resources for public and private investment, improved consumer and business confidence, and a stronger safety net. The opposite is also true. When this debt suddenly does become an issue, it will have very broad implications to our economy and our way of life. Corporations are not exempt either. And I'll sum this up in one word: greed. There's something about our society that when something is cheap, we tend to consume too much of it. And that's exactly what's happening in corporate America today. Debt is readily available. We call it liquidity. If you want to borrow money, it's out there for the taking. And it is very inexpensive. So what are some people doing? They're taking on more debt than they probably should. And the quote here says, very high and rising level of corporate debt in the major economies have been troubling central banks and regulators for years. The deterioration in profit growth has been accompanied by more aggressive corporate financial behavior. Warren Buffett has a saying, when the tide goes out, we find out who's swimming with no trunks. This is a time where we want to be very careful about companies' debt that we want to own. We only want to have companies in our portfolio that we're going to lend to that have been good stewards of their balance sheet. We don't want those who have been swimming without their trunks. So that will be a major thesis in the debt side of our portfolio. Talking of risks, I didn't even need to say it, geopolitical risks. We were reminded right after the turn of the calendar again that we have risks all over the world. We've got tensions in Iran. We've got trade tensions with China. You've got fragmentation of the European economy, North Korea, cyber attacks. You name it, there's lots of things out there in the world that are very disturbing. The more of those that are there, the higher the likelihood that one or a combination can cause a disruption in the market, something we need to keep our eyes on. Trade has been a major topic. I've mentioned the word a couple of times. Trade drives economic activity. That's significant to understand. Especially business investment. We have seen declining investment in many economies, especially the United States. Let me put some numbers to that. This is a chart of GDP. GDP is made up of a number of different components. I'd ask you to focus on the center piece of bar charts. Right in the center, that's the first quarter of 2019. The orange bar chart represents business spending. Go to the fourth set of bar charts. See what happens to business spending? It collapses. Business spending goes from a big positive to a big negative. The good news is, go back to the center set of bar charts and look at the red line, small little red line, second bar in. That's consumer spending. Move over again. Look what happens to consumer spending. Consumer spending increases dramatically and is hanging in unbelievably strong. We could refer to 2019 as the year of the consumer. The consumer represents 2/3 of GDP. If we're out there spending, it is overcoming the softness in business spending right now. Consumer sentiment for the past 3 years has been running real high. We continue to see it increase through 2019, increased about 1%. Business sentiment down 21%. Business owners are laser focused on all those problems, geopolitical issues, problems that could, anything that could disrupt the economy. Consumer out there right now is out spending, having a good time, enjoying a good economy for the first time in a really long time. Regardless of the differences, this is where we see things. GDP in 2020 is expected to come in just shy of 2%. Inflation remains tame under 2%. And unemployment remains very low, around 3.7%. This, I'll tell you, is a picture of a Goldilocks economy. Not too hot, not too cold, right down the middle. So where do we go from here? As I said, it's an election year. We talked about all those things that can trip you up. And there's all these simplifications, and the media is going to be ripe with all these rules to tell you about what the election means to your money. So you'll probably hear things like stock markets always go up in presidential election years. Well, that's not true. The performance of the stock market will be determined, the stock market will predict who the next president is. That might be true, but probably not an easy way of deciding what to do with your money. And a divided political landscape is bad for stocks. Well, I've heard that both ways. These are the type of headlines, these are the type of rules that you're going to be listening to from mainstream media to tell you about what you should be doing with your money based on what's going on in our political environment. We equate 2020 as the year to prepare for anything. And I say it's kind of like this. Imagine that you're planning a really significant event, like a wedding or a graduation, and you're going to do it outdoors, and you're going to plan it in May or October. Well, you're hoping you're going to get a really nice day, but the probability is just as good that you're not going to have the best day that you hoped for. That's how we think about planning for 2020. We hope that we see a certain type of environment, but we're just not positive. We could see these trade wars escalate in a matter of minutes. We could possibly get phase 2 and phase 3, and this trade thing becomes a non-event and the economy is right back on track. Company profits may continue to grow. The consumer remains strong. They're working, they're earning more money, and they're outspending. Or possibly the consumer rolls over like businesses did, and we see consumer spending come down and the economy falters anyway. We could continue to see economic growth, or, as many people predict, we will be in a recession sometime later this year or next year. And possibly this bull market just continues to rage on, or possibly we have a bear market. When we are making decisions in your portfolio, we are of full mind understanding we don't know. And we need to prepare your portfolio for either outcome and have assets that are addressing all of these different possibilities. What are some of the trends that will shape the economy going forward? What are the things that become highly investable in the economy that we're in today? One of the trends, clicks to bricks. And retail is changing its face as we speak. We want to simplify returns. We want to have now the big online retailers are either having their own brick and mortar store or partnering with existing brick and mortars, because what do we want to do? We want to buy it online, return it in the store. They get you in the store, they hope that maybe they'll sell you something else that you really hadn't intended to, and reduce porch piracy. You got all those boxes on porches across America. People are getting really smart about following the brown truck around town and figuring out where to steal those boxes from. I also call it a society of immediate gratification. You remember when Amazon Prime, you get it overnight, was such a great thrill? That's not good enough anymore. People want to buy it online and pick it up on the way home from work. We're getting faster and faster. Well, now they order it for you, right? So this is our society. The face of retail as we know it is going to change. Products and services are going to change. We want to watch those trends and understand them. Renewable energy. In April of 2019, for the first time in history, our renewable resources produced more electricity in this country than coal did. We have vast resources now of solar and wind and geothermal that is changing the face of the utility industry every single day. And guess what? It's changing the financial services industry. Just listen to his CEO of BlackRock the other day. Sustainability and green will become a major priority for many companies in building portfolios that people will be willing to own. So this is going to be a trend that's going to change a lot of things about our economy. The gig economy. And I don't mean gig as in gigabytes. Gig as in, hey, I got a gig tonight. 35% of the working population last year was doing some form of freelance work. Many of those are full-time freelancers today. It generated as much as $1 trillion to GDP. This is a changing face of the US workforce. This will generate new products and new services to be able to serve a workforce that works differently and will need access to different types of things. Another trend that we want to understand. Probably one that concerns us, but is also very significant, newly affluent consumers will expand in Asia and across emerging markets. Emerging market economies today are predicted to represent 6 of the 7 largest economies in the world. In 2016 was China, US, India, followed up by Japan, Germany, Russia, and Brazil. If the numbers here are right, in 2050, India moves into second place ahead of the US, followed up by Indonesia, Brazil, Russia, and Mexico. If this is correct, the United States will be the only one left of the current G7 in the top 7 economies of the world. So the question heading into 2020 is, what may tip the scale? Will ongoing trade uncertainty and weakened manufacturing hurt job growth, finally dragging down the services and consumer side of the economy? Or will interest rate cuts and a resolution of the trade war spark a fresh round of global economic growth? According to Jeff Gundlach, who's the founder of Double Line Capital, he says, well, we are battling tooth and nail the next recession. The Fed is done and the central bankers have done everything that they can, but a recession will come. And that's why you should be playing defense today, just like you should have been in 2006. Bonds are supposed to be kind of a purveyor of what to come in the future. In an article in Forbes, the author says, the wise old bond market is supposed to be the great sage of pending recessions. A flat yield curve? Uh-oh, the economy is faltering. An inverted yield curve? Wall Street is convinced an economic contraction is merely a quarter or 2 away. Listen to this carefully. In a world where stocks are bonds because of dividends, and bonds are stocks because of the capital appreciation when we get declining rates, the bond market might be totally wrong about a recession next year and even the year after. So do we follow the same things that we did before as we move into the future? And if you care at all what Goldman Sachs has to say, but I think some of the information in here will ring from some of the things we discussed this afternoon. While we see relatively low odds of a recession, we are somewhat worried about the consequences when one comes for 3 reasons. First, high corporate leverage could compound the effects of a future recession or a freeze up in the credit markets. Second, high federal government debt and deficits could limit the willingness of policymakers to deliver fiscal stimulus. And third, monetary policy response might also be constrained if a future recession begins with interest rates at an already low level. Sound familiar to some of the things we talked about this afternoon? So, no matter what, I'll tell you, 2020 is definitely going to bring us some new challenges. Brian just finished his capital markets outlook. We do believe that the market has some limited upside here this year, even off of a big year that we had last year. The economy remains healthy. Those headlines are going to challenge us. If the economy stays healthy but doesn't get too hot or too cold, the Fed should remain in check. Fed shouldn't have to raise interest rates. Possibly we see long-term interest rates float up a little bit, but we don't see a significant move to interest rates in 2020. Fundamentals will ultimately drive whether or not we're making any major changes to your asset allocation this year or not. We'll remind you to stay focused on your goals and don't let emotions drive poor decisions. And most of all, I would say to you, remember to enjoy some of the amazing achievements you have already. Have an amazing 2020, and thank you so much for coming.